So you're looking for your dividends to grow and grow and grow. If you're a dividend growth investor at heart, there is nothing better than a passively managed ETF that does it all for you. And with the name Dividend Appreciation ETF, the VIG fund by Vanguard certainly sounds like an enticing option. So in this video, we'll take a look at the VIG ETF in details. We will go through the strategy behind the ETF that produces the result for the fund. We will take a look at the past performance of the fund, including the total return and the dividends. I will show you how the ETF reduces the risk of including companies that are in danger of cutting their dividends, what the current result of the strategy is in terms of the sectors and the top stocks in the ETF, and finally, I will review a strange situation regarding the fund's dividend history that you need to understand if you want to invest in VIG. Okay, so now let's go to Seeking Alpha and take a look at the Vanguard Dividend Appreciation ETF. What we can see at first is that the expense ratio is 0.06%, as you would expect from a Vanguard ETF. I mean, they're famous for that, so nothing surprising here. Of course, they pay the dividend quarterly. This is a standard for the majority of the ETFs. Here we can see the yield. So the yield is 1.78%. Now, the focus of this dividend is not the high yield, but a growing pile of dividends that continue to grow throughout the years and give you capital appreciation at the same time. So I wouldn't expect an yield of, let's say, 3 or 4 or even 5%, of course, but at least for me, every time I have an ETF that gives me an yield below 2%, and the ETF is designed for dividend-paying stocks, I just start wondering whether there isn't a better opportunity around. So if I'm investing in a NASDAQ ETF or the S&P 500 or something like that, which is not specifically oriented towards dividends, and not all of the companies pay dividends, then yes, I will accept a lower yield. I mean, of course, if you invest in a NASDAQ 100, of course you don't expect high yield. Nonetheless, this is different for everyone, so let's proceed. The assets under management, so basically this is the size of the fund, are almost $90 billion, so the fund is a pretty large one. Let's scroll down now and see which index it follows, which will give us an idea about what the strategy of the ETF is. So as we can see here in fund profile, the investment seeks to track the performance of the S&P U.S. Dividend Growers Index. So if we check that on the SP Global website, we will see the description of the index, which basically the ETF is based upon. So here we can see that the ETF contains US companies that have increased their dividends for at least 10 consecutive years. So this is good. This means that all of the companies are dedicated dividend growers and their business can sustain a decade of growing dividends. Here, we can also see that the index excludes the top 25% highest yielding eligible companies, which means that probably the idea behind this strategy is to exclude the so-called yield traps. What is a yield trap? An yield trap is a company that has a dividend which is too high basically to be sustained. It is too good to be true, so to speak. And there is a high likelihood of the business going downhill because the share price has come down and that's why the yield is so high, or maybe the dividend is unsustainable and they will cut it soon. So this is what they're trying to avoid here. Now, I think that's a bit of a blunt way of doing it. There are other more intelligent ways to do it. Like, for example, introducing a maximum payout ratio, which is the percentage of the earnings that the dividend is. But the ETF is what it is, and we'll explore it nonetheless. Let's go to the methodology and see what else we can find out. So here, we need to basically look at a couple of things. The index universe, the eligibility factors, and then the selection and the weightings. And at the end, it's good to have an idea how frequently and how it is reconstituted and updated. So let's go to the index universe. And so basically here they restate what we saw in the description previously. You can see that it has US companies that have increased their dividends for 10 years. It also tells here that the ETF excludes real estate investment trusts. These are companies that own real estate and rent it out, and then they pass on the profits to you as a shareholder. This is standard thing. A lot of the ETFs exclude real estate investment trusts, so nothing special here. Let's go down. Here we can see again that they remove the top 25% of the highest ranked companies according to dividend yield. And then the important part is that we can see that each company is subject to a weight cap of 4%, which means that none of the companies, no matter how good they are or how big they become, can become more than a 4% of the index. Now, whether that's good or bad, this is for you to decide. If you want a more diversified approach and an ETF that gives you broader diversification, then that obviously is good. But if you want an ETF that is more focused because you believe that the winners will outperform the other ones, like for example we see in ETFs like the Nasdaq, well then maybe that's not the ETF for you, because regardless of how big the first company becomes, it will always be capped at 4%. So this is something that you need to decide for yourself. And then if we scroll down, we can see that the reconstitution takes place annually in March. Reconstitution means the removal of existing companies and the adding of new companies to the index. Because the index has certain criteria, when the date comes, the company reviews the index and it removes companies that no longer fit the criteria, and then it adds the next ones. And lastly, we can see here that there are quarterly updates, meaning that on quarterly basis in March, June, September, and December, the company's weight is changing. Basically, this is the percentage of the fund that they have. By the way, guys, let me know in the comments if you like this style of analysis of companies and ETFs, where I share my screen instead of talking all the time to the camera and inserting slides with screenshots non-stop. For all the people who have watched my videos before, let me know which format would you prefer, and for all the new people, leave a comment which style of presentation do you prefer to watch. Alright, back to VIG. So let's go and dig a little deeper into what the result of this strategy is. Here we can see the breakdown in sectors and the top 10 holdings. I always like to look at that because it shows me the results of the strategy. Now, these things are not permanent, and you need to know that. They change according to the market and according to the performance of the companies. But they give me a good idea of what I can expect in the future and what the result of all of these strategies that we just read is. Here we can see a very standard picture. We see that the top sector is technology, nothing surprising there. Financials, second place, and healthcare, third place. This is a very standard picture for a lot of the broader ETFs that I have seen. A lot of them have technology, financials, and healthcare as the top sectors. And then if we go down, we see industrials and consumer defensive, and then below 7% are the rest. Now, the top 10 holdings are interesting because they give us a good idea, as I said, of what the results of the strategy of the ETF is. And here, honestly, I like the result a lot. We can see that the top company is Microsoft, followed by Apple and Broadcom. These are all companies from the technology sector. And then from the financials, we have JP Morgan Chase, Visa, and MasterCard. So obviously the top three in one sector, and then another three from the second biggest sector. And right here in the top 10 holdings, you can see why the sectors have such percentages. Next, healthcare, we have United Health and Johnson & Johnson, two healthcare behemoths, which obviously comprise part of this healthcare sector, which is at the third place with 16%. And the other companies are all familiar names: Exxon, the biggest energy company in the USA, Procter & Gamble, one of the biggest consumer staples in the world, etc., etc. The number of holdings is 343 currently, and those top 10 holdings represent 29.11% of the fund. So this is basically almost 30% in the top 10 holdings. I wouldn't say that this is super concentrated, but it's also not super diversified. I'm personally okay with this because these are one of the top companies in the world in terms of quality. And also we can see here how none of them go above the 4% rate. As you remember, in the strategy, we can see that none of them are allowed to go above the 4% rate. By the way, if you want to know which are my top 4 stocks and ETFs for the current economic and geopolitical environment we are in, you can go to the description of the video and I will send it to your email address for free. The report will always be up to date regardless of when you are watching this, because I'm constantly updating it. So now let's see how the fund has performed in terms of total returns. We find that on the Vanguard website, and we can see here that for the past 10 years, the fund has returned 11.9%. 0.08%, which is a pretty good result for a fund that is focused on dividends. It lags the S&P a little bit, but again, if you invest in a dividend appreciation ETF, your goal is not to beat the S&P or beat the Nasdaq or whatever. So in my opinion, benchmarking yourself against an ETF like the S&P is stupid because you have different goals and each of us is unique and is in a unique situation. So we shouldn't all strive to beat the S&P 500. This is a very big misconception in the investing world. For the past 5 years, we can see 12.87%, almost 13% return, which is pretty good. And then it goes down a bit for the past 3 years at 7.19% because this includes the market crash in 2022. So overall, I think the result of the ETF is pretty good. For the past 1 year, it has returned 20%, which is pretty decent. And it obviously has participated in the huge tech rally, bearing in mind that it has technology as its top sector. All right, now let's look at the dividends. Because obviously, if you invest in a dividend appreciation index fund, you are probably here for the dividends. So let's see how the fund is doing in that regard. As we can see here, the growth rate for the past 10 years is 8.5%, and for the past 5 years is almost the same at 8.46%, basically 8.5%. Now, it goes up a bit for the past 3 years, which is encouraging, and combined, those 3 time periods, the 3 year, 5 years, and 10 years, give me a lot of confidence that the ETF is doing its job. Now, 8.5% dividend growth is pretty good. It's not the best, and you can certainly do better than that in other ETFs or in portfolios constructed by you using individual companies. But I believe that this is a pretty good result for an ETF that has 343 companies. Now, in the past 12 months, the dividend increases have slowed a bit at 6.64%. So that's nothing to worry about because it's only 12 months. I need to see several years of that lagging the past performance, like the 3 years or 5 years or 10 years, in order for me to start getting worried and maybe think that something has fundamentally gone wrong with the ETF and I need to reevaluate my thesis. I know I'm speaking with a lot of different terms here that some of you might not understand fully. And if you're a newer investor that wants guidance on their investing journey, then I invite you to my free investing masterclass. In it, I go through my core investment philosophy that I also recommend to my students in the Dividend Method program. In the masterclass, I compare different styles of investing and I also go deep into the history of money and how the current system is making people who are not investing poor. Even if you're a more experienced investor, in my opinion, the event will be very valuable to you as it has been for thousands of people already. You can sign up for it in the link in the description. Now, the more interesting thing here is that we can see that there have been 10 years of consecutive years of dividend growth. And at the same time, the ETF has been paying dividends for 17 years. So that shows me that 10 years ago, something happened and they could not increase the dividend. Now, this is worth investigating because this is a dividend appreciation index fund. And as we saw, it only includes companies that have raised their dividends for 10 years. It even has the precautionary measure of removing the top 25% of the highest dividend payers so that it can remove the companies that have the potential to cut it. And yet, obviously, the dividend has been cut 10 years ago. So let's see what has happened. If we go down here to the dividend growth history, we can see that the last cut occurred in 2013 and it was a minor one, minus 1.5%, which is not that big of a deal. Here we can see that it went down from $1.41 to $1.39, which is nothing to worry about. And the previous cut happened in 2009. So this one was a little bit bigger with 4.5%, and it went down from $1.02 to 97 cents. Now, what happened in 2009? Obviously, as many of you know, this is when the financial crisis hit. And so for an ETF to cut its dividend by 4.5% in the biggest financial crisis since the Great Depression is, in my opinion, reasonable. Now, I would have preferred for that not to happen, but it's not the end of the world for me and it's not a deal breaker. And here in 2013, As we can see, the cut was minor, and maybe some of the companies were still recovering from the crisis. I'm not sure what has happened. And it's pretty hard to understand because, as we saw, there are 343 companies and you don't know which the companies were at that time. So it would be pretty hard to evaluate. But in my opinion, those minor cuts are nothing to worry about. So what is my overall opinion on the Vanguard Dividend Appreciation ETF? I think the fund is a solid choice for people who have a very long investment time horizon and are willing to wait years and years for the dividend snowball effect to kick in. Also, for people who want capital appreciation as well as income, VIG will probably continue to deliver that as it has in the past. I see ETFs like that not only as a dividend play, but as a hybrid approach where you rely on capital appreciation as much as you do on the dividend income. Personally, for me, I don't like the fact that the starting dividend yield currently is below 2% because to me, this is a kind of a red line below which I don't want to fall for the ETFs in my portfolio that have a dividend focus. However, if you don't care that much about current yield, then in my opinion, an 11% total return combined with the 8.5% annual dividend growth rate for the past decade is a decent result for the average passive dividend growth investor. But for me, personally, mainly because of the starting yield, the iShares Core Dividend Growth ETF with ticker symbol DGRO would be a better choice. In order to find out if you think the same way, you can check my review I did on DGRO by clicking on the video that should have appeared on your screen already. I will see you there.